In a decade of running Nomad Capitalist, we've met more than one person who didn't realize they were liable for taxes in the US. Even if you're not a US citizen, even if you don't live in the United States, you may owe the IRS. And today we're going to break down who has to pay so you can make sure you're not one of them. So the US taxes people differently. We've talked for many years about the fact that if you're a US citizen, you are liable for tax no matter where you live. People often misunderstand that. They're not aware of how the foreign earned income exclusion works. They're not aware that if you're an entrepreneur, you can structure your business overseas and you can dramatically reduce, if not even eliminate, your tax. You also have the ability to move to Puerto Rico and you can knock out your capital gains tax. You can dramatically reduce your income tax on the business you run from there. So you have options, whether it's in Puerto Rico or offshore. Certainly the extreme option is some people just choose not to be US citizens anymore. What people don't realize is that it's not just US citizens who are subject to worldwide income tax, which not only includes the actual tax, but it really is more of the tax filing. You have to report foreign bank accounts if you have enough money in those. Any kind of foreign financial accounts, so brokerage accounts. We've even seen certain gold and cryptocurrency accounts that are liable for reporting. You have to report foreign corporations and put together accounting statements for those. You have to report certain US LLCs involved in offshore structures. You have to report foreign trusts. There's a lot of reporting. And so for a lot of folks, myself one of them, the issue is not that I had to pay tax living overseas. I paid zero or very little tax. The issue was you want to make sure you do it properly. And I, as the goody two-shoes of the offshore business, want to make sure that I'm in compliance, and it is a challenge as an American. But it's not just US citizens. So let me tell you who's involved. I'm Mr Henderson, founder of Nomad Capitalist. We have, for a decade, built a network of experts around the world and an in-house team that helps high net worth and ultra high net worth entrepreneurs and investors legally reduce their taxes overseas, increase their freedom with dual citizenship, and grow their opportunities in other countries. You can learn more at nomadcapitalist.com. If you have any connections with the United States, you probably need, in an international sense, the kind of holistic planning that we do, because we see people who are involved in the US tax net, and then they go and talk to someone in another country to set up an offshore company, open a bank account, get a residence permit, do whatever, and they don't realize what impact the US will have. So not only are US citizens subject to this worldwide income tax, but so are three other groups. First of all, if you've got a green card. So people don't realize that if you get married, if for whatever reason you get a green card, you are on the hook. You have all of the challenges and not as many of the benefits, because as a US citizen, you can leave the country for 25 years, take advantage of the tax incentives potentially, and then just come on back. If you're a green card holder and you leave for 25 months even or less, you're going to come back, they're going to be like, hey, you've abandoned your green card. Now, we work with immigration attorneys in the United States. Certainly the standards are different for everybody, so I'm not giving you any immigration advice, but if you're a green card holder, you're expected to be living in the United States. And this is an area where people confuse permanent residence in the United States, which is the green card, with permanent residence in other countries. I'm a permanent resident of a country where I need to be there 1 day per year to keep that. That wouldn't fly in the US. And so with my permanent residence, I'm not a taxpayer by default, only if I live there the majority of the time. In the US, not only do you need to live there a substantial part of the time for the immigration business part of it, but you will be taxed simply by default. And so we've seen people who have had long-term green cards, 8 years or more, any part of 8 years or more, and they did not do pre-arrival planning, and they ended up paying more exit tax than they needed to. So you could not only be subject to tax as you go, but if you stay too long in the US on a green card, you will be subject to an exit tax. And if you're entering the United States on a green card, you certainly want to do some pre-arrival tax planning. So we've seen people get stung by that, where they had assets coming in and they didn't clearly demarcate where those were. So that was an issue. If you spend too much time in the United States, so generally if you fail the substantial presence test, this would mean that you're spending, there's a 3-year kind of rolling calculation where 3 years, you know, the first year out of 3 is 1/6. So they take the days you were there, divide by 6. The previous year is the days divided by 3, and then the current year, the third year out of 3, would be the days as they were. And so you want to be under half the year, basically, with that rolling calendar. And so that gives you about 120 days a year. We've seen people who they spend they spent a little bit of time in the US for a couple of years, but enough to count. And then they come and they spend too much time and they don't have some other closer connection. They're not under a treaty because maybe they're living on a yacht or something. We had a guy who was a yacht captain, and he ended up spending too much time in the US. He had no other tax home, and so the US gladly took him in and said, hey, you owe some tax. And it took him a long time to get out of that tax net. And so if you just spend too much time, there's 3 different standards that could apply. One of the more conservative ones being that substantial presence test, but you want to watch your days in the U.S. And so for folks who are saying, hey, I want to visit the U.S. in business, or hey, I'm going to leave the U.S. and I just want to come back as a tourist, you need to keep track of your days. Again, it's not always based on the substantial presence test, but that's one way you can look at it, especially if you're not paying tax anywhere else. The other issue is if you want to make an election to be deemed a U.S. taxpayer, you can do that. We actually had a case where somebody had a very weird situation. We were talking to one of the tax lawyers, and he's like, well, I'm like, maybe this guy should actually pay tax in the U.S. Maybe that would be like maybe with like all the treaties and stuff that he'd be entitled to for his very specific case, that would be the best deal. And it's like, well, they're not going to just let him pay tax without really any kind of commitment just to make his taxes elsewhere easier. But in some cases, you can actually make an election to be taxed. Now, if you are a dual citizen, that does not fix the problem. People think, I'm not an American when I live over here. I talked to somebody a while back who's like, no, I'm living in the rest of the world as like a Dominican citizen. Not how it works. An American is an American is an American. If you have 100 passports, they still look at you as a U.S. citizen. And so you can choose to get 1 or 99 other passports and to renounce the U.S. citizenship, but as long as you're an American, these rules apply to you. Now, if you live in some other country there's a tax treaty, you may be able to mitigate the U.S. or eliminate the U.S. taxes, but simply being a dual citizen isn't the issue. It'd be based on where you live as your other tax home, where you could mitigate that. So when people look at getting second citizenship to reduce U.S. tax exposure, I mean, there's some cases for foreigners where that could be helpful. Certainly, if you have a passport, you can go live in a tax treaty country. That makes it more easy. That can be beneficial. But for Americans, the point of getting a second passport is diversification, giving yourself freedom, and knowing that whatever your country, whether it's the U.S. or any other, does, you're not just a sitting duck. I mean, if they roll out a new tax law in a month or in 6 months, you're not going to get a second passport in that time, in almost any circumstance. So if you have the second passport in advance, you're ready to go. If you would not like to be a U.S. citizen, you can certainly get a second passport and then be out. But don't think that because you're a dual citizen that is just a get out of jail free card. Other situations are Americans who live, or theoretically someone who's on a green card who's not American, but a U.S. taxpayer, who lives in Puerto Rico. You can dramatically reduce your taxes there under Act 60. You do have to live there for either almost the majority or the majority of the time, depending on which system you're under. But you are still liable. If you have certain foreign businesses and if you have certain foreign financial accounts, I mean, those have to be reported, and there may be some situations where there's some actual tax due. So you're basically moving your efforts to Puerto Rico for what you're doing, but that doesn't get you off the hook, and you're still a U.S. taxpayer. And so those are people who may fall into the U.S. tax net as individuals. If you have a business and your business has some kind of U.S. nexus, let's say you employ people in the United States, you may be liable to file a corporate tax return as a foreign entity and figure out how much U.S. tax is owed. And so you want to be careful with U.S. business activities. Can you sell to Americans? Sure. There's some debates on like physical products. There's different perspectives on if you're shipping stuff, let's say from certain warehouses, what that liability is. But businesses may be liable for tax even if your company isn't incorporated in the United States. And we've talked separately about U.S. companies and the dangers of using those. I'm not saying that you shouldn't use U.S. structures in your international structure, but you want to understand that there's more nuance to them. And so certain U.S. companies, also U.S. C corporations, will be taxed. And so people have some misunderstandings of the difference between an LLC and a C corporation. Unfortunately, many tax preparers, many tax advisors are very ill-equipped at speaking to that on a global level. They think, set up a U.S. corporation, you don't have to pay tax. That is not true. The other issue is if you have certain U.S. assets. You may not live in the United States, but you may have cash in a brokerage account, you may have U.S. real estate, you may have certain U.S. private investments. Those may be taxed at the estate tax level. So an American is subject to, right now, many millions of dollars in estate tax exemption. If you're a foreigner, it's $60,000. And this is one area where even a lot of the brokerage accounts and banks are very ill-informed. I've talked to plenty of private bankers who have no clue how to protect people against U.S. Estate tax. You need to properly structure any U.S. assets that you have to protect yourself if you're a foreigner. Now, there's some conditions if you have a U.S. spouse. I mean, there's different, but generally speaking, if you're a foreigner, you don't want to just hold, I'm not giving you tax advice, but you don't, I would not just hold a bunch of U.S. equities in my name or U.S. real estate in my name. And we have, with the help of our CPAs and attorneys, connected foreigners who own, in some cases, multi-millions of dollars of U.S. assets that would have had multi-million dollars of tax upon their death paid for a country they don't live in, they're not a resident of, and they're not a citizen of. The money would have just gone out. So you can properly structure by placing that in offshore structures. It doesn't have to be that difficult, but it needs to be done properly. And so whether you live in the U.S., whether you're a U.S. citizen, what they would call a U.S. person for tax purposes, whether you've got business interests in the U.S., I'm not saying that you just sell to Americans through, a consulting company or a SaaS company. That could generally be fine. Or whether you're investing in U.S. assets, you may be on the hook for some kind of U.S. taxes. There's a difference between someone who's only liable for U.S. taxes on their U.S. assets, i.e. the non-resident, and someone who's liable on their worldwide income, so i.e. a U.S. person, citizen, green card holder, someone who spends too much time there. But understand, even on a tourist visa, even on an E2 visa, even on some kind of non-immigrant visa, you may be able to fall into the tax net. And so it is easier in the United States. People think the 183-day rule protects them. It somewhat does, with some caveats, and with the fact that they're going to add up days from multiple years. And so if you're an American, the question is, how do you diversify internationally and stay in the good graces of the IRS while, if you want to go overseas, still reducing your taxes? If you're a foreigner, how do you make sure you're not spending too much time in the U.S. and that your assets, obviously a U.S. business, a piece of U.S. real estate, rent on that, that's going to be taxed in the U.S. You're going to have to file a tax return for that. But certainly you don't want to have to be paying a chunk of your assets to the government when you die. And so those are three areas to look for. We've got a network of CPAs and attorneys that help people with that. You can go to nomadcapitalist.com and learn more to make sure you aren't being taxed where you didn't realize it.